Welcome to the Explainer. Today, we're taking that $10,000 milestone and completely transforming it into an automated, passive wealth-building machine. I mean, if you've ever sat there wondering how to actually make your money work as hard as you do, well, you're in the exact right place. Let's just dive right into this blueprint, shall we?
Here's our quick roadmap for today. We're going to cover waking up your money, busting 3 investing myths, the 3-layer system, 5 steps to execute, and finally, the power of compounding. All right, Section 1, waking up your money. Seriously, it's time to stop working for money. Think about this for a second. You probably wake up early, commute, and just work yourself to the bone for 10 hours a day? You're constantly working for money. But have you ever actually done the math on what your money is doing for you? I see so many people bust their backs saving up for years, only to let that cash just rot in the bank for a few measly pennies in interest. It's literally like busting your hump to carry water up a mountain, totally unaware that there's a giant hole in the bottom of your bucket. Is that fair to you? No way. Absolutely not. We've got to wake that money up. Moving right along to Section 2, busting 3 investing myths to uncover the truth about investing. So myth number 1, investing is dangerous but saving is safe. Sounds completely logical, right? But take a look at the stark difference here. Right now, the U.S. inflation rate is hovering around 3.3%, while the national average yield for a 1-year fixed deposit, it's only about 1.9%. The harsh reality is that your money sitting in the bank isn't safe at all. Inflation is silently shrinking your cash by 1.4% every single year. To really put that into perspective for you, over 10 years, the actual purchasing power of your $10,000 drops to around $8,700. Yeah. Just let that sink in for a moment. Your hard-earned $10,000 actually loses $1,300 of its power just by sitting safely in a bank. Tell me, does that still sound safe to you? Let's rapidly knock out the next 2. Myth 2 says you need huge wealth to even start. A lot of folks think, you shouldn't even bother unless you have hundreds of thousands of dollars. But the reality? $10,000 is the perfect starting line. It's kind of like using 10-pound dumbbells at the gym to perfect your form before you move on to the heavy lifting. It's really all about building the habit. And then there's myth 3, which claims investing requires staring at charts all day long. Look, unless you're a professional day trader, your 9-to-5 time is way too valuable for that. The whole core spirit of passive investing is just admitting the market is smarter than you. Just join it, let it do the heavy lifting, and go live your life. Okay, Section 3, the 3-layer system. Let's automate your wealth. Proper asset allocation really shouldn't be stressful. Think of the system kind of like setting your washing machine. You pick the cycle, you hit start, and you just walk away. Here is how we split that $10,000. We divide your money into 3 core layers, a 20% emergency safety net, a 60% core growth engine, and 20% in flexible cash, which we like to call opportunity bullets. Let's break these down so you can really see the logic here. So layer 1 is your safety net. We're taking $2,000 and holding it back entirely for emergencies, kept nice and liquid in a high-yield checking account or a short-term deposit. Now, you might be wondering, wait, isn't that a waste of investing capital? Trust me, it's not. This $2,000 provides the ultimate psychological security. It ensures that when life throws a curveball at you, like a burst pipe, a broken-down car, or a sudden job loss, you aren't forced to sell your long-term investments at a loss just to cover the bill. Basically, it's your financial shock absorber. Zooming in on layer 2, we have the growth engine. This is your 60%, or $6,000. Notice the breakdown here. We split this chunk into 70% broad stock ETFs and 30% bond ETFs. Why this specific ratio? Well, because stocks give you that nice 8 to 10% long-term growth, but they're highly volatile. Bonds, on the other hand, offer around 3 to 5% and act as your anchor. Combining them together means your money grows steadily, but without those wild, stomach-turning market swings that keep you up at night. Now, an absolutely crucial point is how you actually put that $6,000 to work. Whatever you do, do not dump it all into the market on day one. Instead, we're going to use something called dollar cost averaging. As you can see, this simply means you divide that investment into regular, smaller amounts. So for instance, you deploy $1,000 a month for 6 months. It's a brilliant strategy, honestly, because it averages out your purchase costs over time and completely removes the impossible, anxiety-inducing stress of trying to time the absolute bottom of the market. And finally, we have layer 3, opportunity bullets. This is your remaining 20%, that last $2,000. You keep this as flexible cash, earning maybe 2 to 3% in a money market fund. It just sits there, waiting.
Then, when the broader market drops more than 15%, boom, you deploy it. Having this ammo gives you a priceless psychological advantage. While everyone else is panicking and freaking out about a market crash, you actually get excited because you have the cash on hand to buy premium assets while they're on sale.
All right, Section 4, 5 steps to execute your action plan.
Here is your rapid-fire execution checklist. Step 1, open a brokerage account. Seriously, it takes maybe 10 minutes online. Step 2, set up auto transfers. This is a real game changer because it completely bypasses human laziness. Your money leaves your checking account and invests itself before you even have a chance to spend it. Step 3, pick total market ETFs like VTI or VOO. Don't overthink finding the perfect asset, just get started. Step 4, rebalance biannually. Once every 6 months, adjust your portfolio back to that 70-30 split. It feels totally counterintuitive, but it automatically forces you to sell your winners high and buy your losers low. And finally, step 5, keep learning the macro trends, but please ignore the daily noise.
Last but not least, Section 5, the power of compounding and playing the long game. So, with the whole system running completely on autopilot, we need to shift our focus to the long game and uncover the true magic of this strategy. Just look at how this initial $10,000 snowballs over time at a very realistic 7% return. In 10 years, it doubles to nearly $20,000. In 30 years, it becomes over $76,000. And if you add just $200 a month to it, that number balloons past $300,000. Your money is no longer sleeping. It is literally working overtime for you. You know, Albert Einstein famously called compound interest the eighth wonder of the world, and he definitely wasn't joking about this. When you watch those automatic dividends hit your account for the very first time, it is magical. It truly feels like planting a slowly growing tree. Sure, it takes patience, but eventually you know for a fact it's going to bear massive, life-changing fruit.
But let's be completely honest with each other here. You will hit bumps in the road. And this brings us to the core thesis of this entire explainer. Your biggest enemy in investing isn't the market. It's your own emotions. When inevitable market crashes hit, and trust me, they definitely will, looking at those paper losses just feels awful. Having a rigid system in place is literally the only way to override your natural human urge to panic sell. The system dictates the plan, not your fear.
And let's look at one final, absolutely crucial piece of the puzzle. Your biggest asset isn't just your investment portfolio, it's your own human capital. Investing in your skills can massively boost your income. Take this real-world example. Someone who started with just $10K but worked incredibly hard to upskill, effectively doubling their salary from $60,000 to $120,000. Growing your income means you have way more money to feed into your system every single month, which drastically accelerates your compounding wealth. So never, ever forget to invest in yourself. Which leaves us with this final vital question. What are you going to do with your next 30 minutes? Seriously, stop waiting to feel 100% ready because you never will be. The risk of doing nothing while inflation eats your money alive is far, far greater than the risk of the market. I challenge you to spend just 30 minutes today opening an account and taking that first powerful choice toward financial freedom. So will you wake your money up today?